I'm not a fan of Disney at all. I'm not an investor in Disney. I do not have a position in the company because I think that it's being ran into the ground. I think that they took on too much debt when they bought Fox, and now they're trying to make a series of moves that I believe is not in the best interest of investors, and they're going to have a very difficult time pivoting at a time where nobody has the amount of money to be able to take these assets off of their hands, and they're not willing to take on a debt as a result of it. But let's deep dive into Disney because I just recently came across this. I actually came across it a few days ago in an investor's call. But Disney is looking to invest over $60 billion into their theme parks business. Let me say that one more time. $60 billion into their theme parks business. Make sure you subscribe to the channel. Make sure you hit a like for the Facebook and the YouTube algorithm. Also, on top of that, make sure that you tap into the Patreon. The link is in the description. I'm going to be doing an Invest in Your Business series where I'm giving out money in order for people to start up their businesses or vet out the idea behind starting up their business with no attachment, so you're not going to have any investment in me, or I'm not going to have any equity in your company. Then I'm doing a meetup over in D.C., and then I'm going on tour next year. I've already made up my mind that I'm doing it. But make sure y'all hit a like. Let's get into it, and let's deep dive into it.
Hi there, Waltoneers, I'm Jack, and this is DSY Newscast with a breaking news video. As you see today, senior Disney executives held a conference with Wall Street analysts and investors at Walt Disney World, where the main topic of discussion was to prioritize and focus in on the future of the Disney Parks and Resorts division. Now, in all honesty, I'm not going to bury the lead here, as the main headline coming out of all of this is that Disney has announced via an SEC filing, and through a press release on their corporate company website, that they are planning on nearly doubling capital expenditure investments into the Disney Parks and Resorts division worldwide over the next 10 years. Which means that they're planning on spending approximately $60 billion over the next decade.
Somebody said, what's wrong with theme parks? Nothing is wrong with theme parks. If you like going to theme parks, but everything is wrong with theme parks if you're looking at it as a company that's allocating their capital wrong, in my opinion. All right, so let's look at it from a logical perspective, right? And I want to put on my C student's hat because I want to break it down from a perspective in which you can truly understand, or at least understand it from my view, so that you guys can get a different perspective on how it is that you need to be allocating your resources. Let's say, for example, you wanted to invest in Disney. Now, Disney has multiple different divisions. They have Star Wars, they have the movies division, right? They also have their online streaming, which they rush to pour money into. That is not making any money from them. They also have divisions dedicated to content creation, right? Which means that they got the ESPNs, recently fired a bunch of people over at ESPN, reallocated their resources, brought in Pat McAfee, and then also brought in Shannon Sharp to be a part of First Take 2 days of the week, and then Club Shay Shay is doing its own thing, right? Disney has multiple different divisions. A part of those divisions is the theme parks. So you got Disney World, Disneyland. Those are over in Orlando and California, respectively. I recently visited the Disneyland / Disney World over in Tokyo. So last month I was over in Tokyo and I had an opportunity to go there. It's a completely different culture. They celebrate Winnie the Pooh above any of the Marvel characters, right? They celebrate Cinderella and all of that type of stuff, Snow White, way more than they're celebrating Iron Man, right? They're not really checking for Star Wars. They want to see the Star World around Star Wars, right? So the cultures are completely different, and being able to travel to different countries, you get to see the differences in the culture. Now, from an investor's perspective, we just seen the pandemic, right? We just seen the pandemic. And the pandemic should have been a wake-up call to people that want to invest in certain different companies. Give you an example. What is the first thing that people start to cancel when everything goes bad, whether it be from a financial perspective or a disaster perspective as far as war, pandemic, recession, anything? What is the first thing that people start to cancel? Or what is the first thing that shut down? And when you've seen it happen during the pandemic, what did we see play out over at Disney? Theme parks shut down. People cancel airline tickets. The hotel industry suffers. Leisure industry suffers. And then anything as it relates to tourism is going to suffer. On top of that, right, we know that Disney is holding an extraordinary amount of debt as a result of purchasing Fox's assets, in which they had to divest from FS1 because they didn't want them to have a monopoly when it came to ESPN and FS1, so they had to sell that. But they went on and they took on a ton of debt because they were competing against Comcast in order to buy the assets in order to start creating the digital content and the streaming service, in which they still can't compete with Netflix. People have been canceling Disney. They also went too woke. People have been walking away from it. I canceled my Disney Plus subscription. And so all of the accelerated growth that they had as far as growing a platform didn't translate into profits. And then on top of that, they still holding on to an exponential amount of debt. And then they're allocating resources over into the theme parks, which is profitable, but it's the first thing that people cut off when they start to have problems within their own households or in the economy or any kind of thing that they have to start making adjustments to. They cancel out all leisure activity. They stay home. They go and do stuff local. They become a tourist in their own city. Or they just go ahead and they just start to dig deep. If somebody don't have a place to live, they sure as hell ain't got money to go over to Disney. Now, you combine that with the idea that the theme parks are crazy expensive to go to now, right? You have to wait in these long lines. You have to spend a week there. You also got to get a hotel. You got to get plane tickets. Most of the time, you want to take your kids to it too. And so when you start to take all of that stuff into consideration, and I visited Disney World / Disneyland in Florida this year, and I went to the one over in Tokyo, right? And I know they got one over in Shanghai. When you start to think about all of these things, what is the return on investment when you spend $60 billion? And how long is it going to take them to recoup that, on top of the fact that they have an extraordinary amount of debt sitting that they have to pay for? And that's one of the reasons that they're starting to institute company-wide layoffs across the board. They're also having problems with the cable companies. People are cutting the cord even more, and so now they're going to have to differentiate themselves as far as competition with the different streaming companies in order to try to incentivize people to buy the ESPN Plus package, buy the Disney Plus package. They don't even know how to segment out what it is that they're doing from a streaming package perspective to make it attractive or a bundle for people to want to purchase. So now they just say, okay, go and get Hulu. But you can still get Disney Plus streaming separately. So then allocating $60 billion over into continuing to develop theme parks, thinking that people are going to continue to support the theme parks and all of the costs that's associated, which that's going to be passed on to the consumer, and it already costs too much money. They're going to have to sell something, B, lower their debt, and then C, figure out where they can put their capital investment in order to stay competitive going forward. And I don't think that theme parks is the way to do it. Certainly not at a $60 billion cap rate.
Which does sound very exciting and very promising. But let's dive a little bit beyond that headline and get into this in greater depth. As you see, when you hear $60 billion in the headline, it sounds like an absolute ginormous amount of money. But if you were to break that up evenly over the course of that 10-year period, it means that Disney is looking to invest on average around $6 billion into the Disney Parks and Resorts division if it was to be split up evenly over those years. However, that sum of money isn't just for the domestic Disney parks, but this has to also account for all of the capital expenditure investment for the 3 other theme park resorts around the world that Disney own, along with the Disney Cruise Line as well, which is currently constructing 2 more multi-billion-dollar cruise ships.
So let's pivot for a second, right? I want to share something else with you guys, because Disney is also looking to offload some of their assets in order to continue to raise money and then lower their debt obligation.
Let's turn to Disney, which is in talks apparently with several bidders to sell its ABC network.
So one of the things that we've seen has happened over the last few years is that there's been a race to the bottom in order to try to compete in the streaming wars for them to own the assets and to own the catalogs. Now, I think that Disney did themselves a huge disservice by forcing themselves and trying to run into the streaming wars to compete with the likes of Netflix and Comcast and Amazon. And Amazon is largely being shared, all of their profits is coming basically from Amazon Web Services and all of their other divisions. So, they got that backing to continue to keep them afloat. They're not necessarily trying to make money as a result of it. Apple is the same way, right? Apple generates the overwhelming majority of their profits, and their strongest growing division is in their services division, right? In their subscription services. You get Apple Arcade, you get this, you get that, and they bundle it together. And you also get Apple Fitness Plus, and you also get Apple TV, right? And so Netflix is always going to be the leader because they focus all of their energy on creating the best platform as far as streaming services, and they also allocated money, and they seen this happening a long time ago, and so they started investing in themselves and then doing original programming. That's where you got Orange is the New Black. You got a lot of the great shows that was Emmy winning and award winning and all of that, right? And so Netflix is incredibly profitable, and let me just be very fair. I am invested in Netflix. I have been for a long time, and it's been a great company. So I am not a financial advisor. I'm not giving you financial access. I'm just telling you where it is that I'm investing. Disney, on the other hand, raced into getting into this whole world by owning and also purchasing a lot of different content that they then reduced the licensing for. So when you used to see Endgame and all of these different movies, and you used to see it go over into different TV shows, and when you see BET put on all of these movies, right, and they look like they got Chinese words, they make money from that, right? When you license out your content, you don't have to put any resources into it, and all you're doing is continuing to make money from it for the entirety of the life of whatever platform continues to license it, right? When you used to see on Netflix all of the Marvel movies, and then you had Daredevil and all of this stuff, right? Disney was making an egregious amount of money while not having to develop a platform in order to stream for themselves. But what they did was they cut their feet from under them by removing the amount of money that they were making from licensing this content, and then they started to have it exclusively on their own streaming platforms, hoping that you guys signed up for it and that you could continue to make money from it. And so they were going to make money differently, right? The money was going to be reallocated differently than the licensing. It was going to start coming as a part of, hey, if you want to watch Marvel stuff, if you want to watch Captain Marvel, if you want to watch Iron Man, if you want to watch this, then you got to sign up for Disney Plus. Well, eventually people was like, nah, this is trash. We don't want it anymore. And you guys are going woke. And so the Disney Plus streaming platform, as far as my research is concerned, I could be wrong, but it's losing a lot of money. It's losing a lot of money. On top of the fact that they had to go into so much debt in order to purchase all of these assets that they wanted on these streaming platforms in the first place. And so now this is where you're seeing all of these layoffs. This is where you're seeing the majority of their money having to be dependent on the theme parks and stuff like that. And it's a bad situation all the way across the board. But one of the things that they realize is that we have too many assets and we're not making any money as a result of it. And we got all of this debt and we got to raise capital to stay afloat. So we're going to try to sell off some of our businesses and partner in order to continue to raise money so that we can have the capital investment to go forward in the future. This is why you're starting to see Disney have these announcements, and I warned you guys that they were going to start having these conversations about selling assets, including ABC. ABC is now on a shopping block, and they're trying to get it offloaded before it becomes even more devalued.
Something the CEO Bob Iger has hinted might happen as he tries to remake the company in the streaming era. The stock, Disney, down 23% this year and more than 50% below all-time highs.
So, for the person that was in the chat that said Disney's is doing really good on the stocks, no, it's not. No, it's not. There's plenty of companies that are doing incredible this year. And Disney is not one of them. Disney is down over 23% and over 50% from its all-time high. Disney is getting killed right now. And so this is why I'll talk about in the Patreon is 8 things that you need to look for when you're looking to invest in a company, because your understanding of that company intimately is more than just what it is that you see on the surface or what their stock price is. How do you know what to value a company? How do you know how much debt they have? How do you know what their management strategy is? What is their long-term investment? Where are they going to be making their money in the future? How much is money going to cost them as far as holding on to debt long-term? All of these things are going to factor into the value and the price of what this company is really worth. And so you have to take that into consideration before you start to invest in these companies. But let's continue.
Hi, let's bring in CNBC.com's Alex Sherman now with more on how this process could play out and who the possible buyers could be. Alex.
Yeah, thanks, Tyler. So I think we're early. We're very early in this process still. In fact, Disney released a public statement last night saying, look, we've made no decisions whatsoever here. But we're thinking about what we might do with our assets, which echoes what Disney CEO Bob Iger said to our own David Faber a couple months ago. Disney wants to transform its business to a more modern-looking company, and it realizes that the traditional pay TV bundle is declining, has been declining for years. And it's kind of finally it's come to Jesus moment here where it's like, look, we may need to modify this company. We may need to sell off some of these assets that used to be crown jewels for us that aren't anymore.
What could be bundled along with ABC in any possible sale, and who might the buyer be or buyers?
So
I don't know. Maybe ESPN?
There have been preliminary discussions with Nexstar. Nexstar is an owner of many different local affiliate TV stations around the country, but it also owns some national assets. It owns the CW network, or the majority of it. It's starting its own sort of news network called News Nation. It owns The Hill. It owns other digital media assets. It makes a lot of sense.
And The Hill is trash, by the way.
That Nexstar would be interested in buying the 8 owned and operated local stations that Disney owns, which are in big markets, typically Chicago, New York, LA. Disney owns 8 of these things in addition to the ABC network. The interesting question is, does Nexstar also buy ABC? That would be really industry changing if one of these local TV network affiliate companies owned the network itself. That doesn't exist today, of course.
I think that Disney is still in trouble. I'm not a fan of it. I'm not telling you what to do, but I'm not going to continue to invest in it. I think that you guys should continue to dollar cost average, and that your investment has to be automated, but make sure that you're very, very careful about where it is that you're allocating your resources. You don't just want to dollar cost average into anything that's going down. You want to dollar cost average and put all of your resources in the things that you research the most. Make sure you guys get into the Patreon. Link is in the description as well as pinned to the top of the chat.